Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it is Tuesday. Again, we have a relatively light news week. So let's relax. I think we got a little bit of algorithm stuff to look at today. So first, let's come over charts and see where we've been going. Even though it's kind of a dead week, we have been having some interesting things happening in the market. So yesterday, there was a pretty good run up, over the weekend and in the morning hours. Pretty good up move, and that up move continued through the day. Nothing crazy, but we did move up. Overnight, they've been pressuring it a little bit, but then here, as the session has started, they are on the upside again. And the only really significant news I remember seeing here was one of the Fed members. I can't remember who it was, Dudley Waller. I can't remember who it is, but saying that they're going to vote for a rate cut at the next meeting, even if they're the only one. Okay. We can talk about that later because I think it's an incredibly interesting thing. All right, and then we got the S&P 500. S&P 500 had like a pretty good run up through the first part of the day, but then going into the close, goodish. So, I was concerned that we were going to get an unclenching, and so when the start of the session went okay, I was like, oh man, I guess I'm wrong. I guess other factors like seasonality and buyback windows opening up more important. But it looks like that the unclenching happened, and it's just that they were waiting until the close for the liquidity to do it. So we may continue to see some pressure in the markets, although and the timing of all of that is kind of interesting. More bigger picture, we are in a relatively bullish period. This is kind of like, I think we tread water for a little bit, but once this next big period of positive seasonality passes, I think we're in for some pain, and moving into the fall, things could be a little painful, especially depending on how some of these trade deals go. Here we got oil giving up some of its gains, and past 3 sessions not looking so hot for them, but more generally, I still think that we could possibly see 60 in oil. So gold still looking pretty good. They're looking like maybe they're gonna do another leg here. Silver, and man, if silver breaks out there, woo! Can you guys imagine a greater than $50 silver? Ooh, that would be a world. Okay, and then here we got copper. Copper also kind of trending upwards a little bit. And the yen, not as big of a move. So remember yesterday they had a right-wing party in Japan winning things. That's a whole story too. The dollar pretty flat today, and Bitcoin are pretty decent. I mean, of course, it's just the top of the range, but that's a pretty good move there. Yeah, so I've seen a lot of stuff so in Japan, there's a lot of people kind of saying, well, they want Japan first, essentially. Like, that's the party that kind of took over. They are Japan first. And that's a little wild. I mean, of course, I'm in favor, generally speaking, of America first, although I think people have taken it way too far. But Japan, hasn't Japan always been Japan first. Like, you know, like, okay, so they've pretty much always been Japan first, and now they're saying they're not Japan first enough. Seems a little, and then people are saying, well, what you're going to do is you're going to say Japan first, and you're going to, throw off any kind of relationships that you have with anybody else, and that's going to hurt you. And I think generally speaking, that's true. You know, I think that we're kind of starting to see now within this larger geopolitical debate that we've been seeing across the world about globalism. We're starting to see the extremes now, right? There are some people that think that it should just everything borders everything, and they want everything to mix until there's no trace of any kind of race, ethnicity, or nationality anywhere in the world. I really think that's what some of these people want, which isn't necessarily like on its face a bad thing, but I think when you actually play it out practically, it actually ends up being a very negative thing. And then you've got this other side that is like every nation should be its own ethnic enclave that is completely self-sustainable and doesn't interact with anybody. That's kind of what Japan's party sounds to me, you know? And there has to be balance to that. You know? Do we have any trades? Well, the robot, it went long. Japanese news and TV constantly talk about how negative the work culture is and how much people want to change it but can't because it goes against the norm. Welcome to Japan. Yeah. Oh, did you win? Well, yes. Yesterday, the trade that it took ended up being really bad, didn't it? I don't remember the exact specifics of it.
Block sell.
I don't particularly want to be taking trades, you know? Yeah, see, it was like long here, and it got screwed over. But then it took a long here, and it did okay on it. That's interesting. Oh, I went way too far back. This is the one yesterday. Yeah, where it went long, and I was like, crap. But it looks like it kept going, and it made it back. Ooh, and then... Oh, no, that one's no good. You know what? We should change the colors here just a tad bit. Because I'm that pink. Like what if it was like hot pink? Now, then it's too hard to see. And lawn green is just is not quite green enough for me. Misty Rose. Maybe something more orangey. Beige. No, I don't know. Maybe salmon pink. Oh, I didn't see that here. All right, salmon. These are the blues. Deep pink, hot pink, pink, light pink. Crimson. I don't know. Crimson kind of works for me. Crimson kind of works for me. And then this lawn green, instead of lawn green, we can make it like cyan or something like that. Or cyan. now I'll never mistake them again. So what did it do? It went long and got fully stopped out. It went short and got screwed. And then it went long and it turned out okay. And then it went short and it lost. I haven't looked. So I wouldn't expect it to be doing very well during this period. I wouldn't expect it to be doing very well this period. But I have not bothered to go and look at stats on it lately. Is it saying since the 15th? When was that? Oh, well, I don't know if that counts, but I think that it's really only showing us the past 3 days. Yeah, like, well, what if I just changed it to be that? Will it change? Yeah, it's no different. So that I'm correct. It got 1 winner and 3 losers, and one of the losers was the full 8 ticks. So that kind of sucks. Largest, oh, it got 5 and 8. So like we've got something that like it works really well when I really think that we got something that's good. Honestly, I think it's doing what I want it to do, which is when you start to get a big imbalance in the market orders, there is a market regime where that will result in a trend and go really well every time. And then there's a regime where that will go really poorly every time. So we are in the regime where we would want it to trade against the flow. And that is partly, it's a quiet week, lower volatility. It's also partly that we are getting into the later half of the futures contract now. Right? Because I forget. Is this, oh, it's September. So we've still got a month left in it. But you get what I mean? So if we are able to put a Markov model on top of it, I think it could be pretty amazing. But we'll see. I have to stop being lazy and get in and start implementing that stuff. And there's other things that we got to do. What were we talking about? We were talking about Japan. Yeah, the work culture in Japan is crazy. Like when you take the really hardworking kind of capitalist culture, and then you go and you give it to Asian cultures, they take it way too far, don't they? Like Korea is even worse. Like what's going on in Korea right now is really crazy, frankly. I don't think we in the United States realize, because we're always talking about, like look at how well South Korea has done compared to North Korea. And that's true. But that doesn't tell the whole story, right? Because South Korea has had a lot of political instability, and their work culture there is terrible. The birth rate there is terrible. Japan is kind of going down the same path, and you're starting to see some of that in China too. Anyways, but like more broadly, so here's something that I've kind of realized over the past few months. Our connections between each other matter. We in America, we have this idea that meritocracy is best and that everything should be pure meritocracy. And that's not true. Pure meritocracy is a nightmare. Can you imagine that your place in the economic ladder at all times is completely 100% based on your current performance. So today you're performing really well, you're at the top, and then tomorrow you didn't perform as well, you're at the bottom. Like, that would be pure meritocracy. One that reflects your work at any one instant. That would be a nightmare. You would never have any security. In our system, we kind of have like this latent meritocracy, right? It's like you do really, really well in one spot, and then you can kind of relax a little bit and run on that, you know? But the truth is that the world out there, nature itself, is rough. And so we as a species, the way that we have dealt with that, the big innovation that our species has made is the relationships with each other. That's what brings us security. So if you're hiring for something, right, and you get a referral from one of your employees, like somebody that's already working for you, they say, hey, I have a friend that's really good, you should interview them. We're absolutely going to interview them probably, right? That's how it works. So you don't want pure meritocracy, and obviously pure, nepotism, that's awful too, right? That's like feudalism, right? But you need a little bit of a mixture of both. And it's the same when you go out to like the geopolitical stage, right? Our relationships with other countries make us stronger. The problem is that we have taken it to such an extreme that everybody's taking advantage of us. Is that what was happening in Japan? I'm a little bit skeptical of that. You know? So, I don't know. Is this new party in Japan going to have a measurable change in the country? One of the things that I think is funny when watching the geopolitics is we'll be like, okay, like now there's a more right-wing party over in Japan. There's moving more right-wing in Europe. And it's kind of been everywhere has been moving a little bit more right-wing. But like, has it actually had a measurable difference? I don't know. It kind of makes me wonder, do we read too much into who the president is at any one time? They sure won't have a measurable change. Japanese are still people, even if they hate how it is now. Imagine having to go through entire huge wide country changes. Change sucks. Yeah. Well, but now here's the other side of it, though, and the part where I kind of feel for the right-wing people is that what they're saying is we need to import more foreign workers and we need to make things so that we can be competitive and do all of these things. And from my perspective, I'm kind of like, well, yeah, I personally wouldn't want to go and live in Japan. It kind of sounds to me like living in Japan as a foreigner would kind of suck, right? But that doesn't sound like a long-term solution. Like, it's maybe a solution that maybe works for the next 100 years. But that's like what all Western countries have been doing, right? So they're like, well, not enough people are having children, and we need more people, and we need more expertise and everything. So what we got to do is we've got to import it. And it's like, okay, cool. That works until, the next 100 years when Africa has completely industrialized and come into the information age. And then what do you do? Now you've had the whole world kind of using the same strategy to keep themselves going, and it won't work anymore. And then what? You're all screwed. Doesn't seem like a long-term solution, does it? Can you explain the difference between ZB and UB? Slim, that is such a great question. I cannot help but just answer that one. So the difference between ZB and UB is the duration of the treasuries that are eligible for delivery. So in ZB, there's certain QSIPs, and actually, let's go and do the whole, we haven't done this in a while, so let's go and look. If we go to the CME website, cmegroup.com, trading interest rates, and then we come here, close that, and we go to tools, and then we can see Treasury analytics, I think is what we want to look at. Oh, I have to log in. Hold on a second. Okay. And now we can see the different treasuries. So we want to see September delivery day, Treasury T-bond. Can I get it on, I thought that there was a way to, delivery baskets. Yes, here we go. Okay, so if we come to the Treasury bond, come on. Okay, so we come to the Treasury bond. It comes in here and it says there's these QSIPs, right? So these are all different bonds, right? The Treasury, a couple times a month, they go out and they issue new bonds, right? And all of the bonds that are issued that day at the Treasury auction, they're all given the same QSIP, okay? And so what we're saying with the futures is that on delivery day, you can deliver any of the following QSIPs. See that big long list of QSIPs? Now, there's one QSIP which, based on the yield and all of this other information, there's one that is actually more efficient to delivery, to deliver. And that's what the price tends to be based on, is that cheapest to deliver. Okay? But you can deliver any of these. So there's a problem with that, which is if I want to do a 30-year, since the 30-year is basically like the biggest bond that the U.S. offers. You see how much shorter that list is? See how much shorter that list is? So what has happened over time is in ZB and ZN, they have expanded the number of QSIPs that are available for delivery so that there can be more liquidity in that instrument. With me so far? The problem with that is that the actual maturity on this ends up being not actually 30 years. So here we are on the Ultra T bond, and it says here's the cheapest to deliver. Cheapest to deliver is actually a 29.67 year bond. And if we come back up here and we change this back to the T bond, and now the cheapest to deliver is actually a 19.67. So we say ZB is a 30-year bond, but it's actually more of a 20-year bond, right? It's the same thing with ZN and ZT. Is it ZN and ZT? Yeah. If we go to the 10-year, okay, the delivery is actually a 6.75. Whereas when you go to the TN, the Ultra, then you get something that's closer to an actual 10. So that's the difference. Now, which one should you trade? My recommendation is to trade and or at least watch the one with the most liquidity. Like, you can make more money trading UB because you take a trade, it's going to go further in UB than it is in ZB. So you can make more from UB. There's more risk involved in that too. So that's the first thing, is I wouldn't automatically go to the thing that makes the most, that has the most volatility essentially, or it had the most risk. Okay. So I prefer ZN for over ZB for that reason. Okay. But if you really want to trade the big one, fine. But watch the one with the most liquidity as well. So if I'm going to trade UB, I want to have my UB DOM up where I'm executing, and I want to have my ZB DOM up to see what the 20 years essentially doing. And I would recommend having ZN and ZF up as well, because you're going to see volume across the curve. And ZN tends to be the one with the most influential order flow and order flow signals. Okay. So that's the difference between them. Okay, so Adils asks, how do you use correlation between markets or between different instruments in the same market? And is that even useful for trend followers? And if yes, how can that be used? Okay, well, so you use the word trend followers. When you talk about trend following, my what I think of in my mind as trend following is I'm going to go and look at all of these different instruments on a daily basis, and the ones that have a certain amount of time series momentum, I'm going to get into those ones, long or short, right? So for a trend follower like that, that's really like a portfolio daily level strategy. And I'm going to pay attention to the correlations a ton, because if I come in and say, well, ZN is moving up on a daily basis, so I want to be long ZN, but then gold is also moving up on a daily basis, I want to be in gold. Well, those are all like highly correlated. So I don't necessarily want my whole portfolio to only be gold and ZN. That's twice as much. Why wouldn't I just take twice as much in ZN, for instance, right? So based on the correlations between instruments, I might size some positions smaller to limit my risk to any one particular factor. Okay. But my guess is that you did not think that that's like what trend following was. And you were thinking, I'm scalping and I'm just looking for things that are moving up and I want to get in them, right? Okay, so first thing is just realize that momentum is an effect that we can see on daily bars, but not on intraday bars. On daily bars, you can be in a position for months and months and months, and it will make so much over a year that it more than makes up for your losses. But on an intraday basis, there's a limit to how far it can go, and the math doesn't work out. So just pure momentum on intraday charts doesn't work, okay? But you can scalp, and there are ways to scalp. There are market-making strategies. There are short-term inefficiencies that if you're a robot, you can take advantage of, or you can do what we're doing, which is essentially being informed traders and supplementing that with our read of the order flow. Okay, so as it turns into reading the order flow with respect to correlated assets, here's what you need to know, especially when it comes into the treasuries, is that these treasuries, they're all going to move together. It's pretty rare that you see ZN move down and ZB move up at the same time. I've literally only seen that 2 or 3 times in the 8 years we've been doing this. Okay, very, very rare. What will happen instead is you will have a move up and one will move more than the other. And the way that we deal with this with our DOM is I have this button here that if I right click it, it will center all of my DOMs at that time. So then I can see how much each instrument has moved since I recentered things. So I haven't recentered them today. This is just from where we started at. But where we've started at, you can see that ZF is up a little bit more, 1 tick more than ZN, which is up 1 tick more than ZB. So there is a change in the spread. There is a change in the spread. And we can see that over here in our charts, maybe a little bit. That's this data series down here at the bottom. So it's not changing very much, but it did steepen by 1 tick over this last move. Okay. Today, bad example. Here's a better example where it was flattening. That would mean that ZF would sell more while we were moving up. We were moving up, but it flattened. That means that ZB moved up more than ZF did. Okay. Remember, up is steep, down is flat. That's all you got to remember. Up is steep, down is flat on these charts, right? And then when I come back over here to my DOM, the reason that I have ZB on the left and ZF on the right is so that it's the same thing. Up is steep, down is flat. Okay. And then the next thing that you have to remember is that steep means you buy the front month and sell the back month, and flat means you sell the front month and buy the back month. Okay. In other words, steep, I buy this one, sell this one. Flat, sell this one, I buy this one. Easy to remember because, again, you know that up is steep and down is flat. Okay. So that's how you remember the directions of them. A lot of people, they'll try and go in and say, okay, well, if here's the yield curve and then we're flattening, that means these ones are coming up. And so then I have to translate that to prices and you're flipping things all around. It doesn't work. It doesn't work. Just remember, up is steep, down is flat. You come in and you watch that every day for a week and it will just become second nature to you. You know which one you're buying and which one you're selling. Now you can kind of sort out the order flow. Now I can say, okay, we're moving up, but we're also steepening. That means there's going to be buying over here, selling over here. That means if I see a lot of volume really heavily buying over in ZF, I have to discount that a little bit. Because that volume is probably from the spread and doesn't necessarily affect what we're going to do outright. Because we're taking a position outright. I'm going to make money whether it goes up or down, right? Same in ZB. I'm seeing we're steepening. Then if I see a ton of selling over here in ZB, I don't go, oh, we're going to sell and go short. No, because that selling is because of the steepener, right? So I have to account for spread trades in my reading of order flow. And more generally, like when we talk about order flow, what is order flow? Order flow is a study of all of the orders in the market, not just the market orders, but the limit orders too. And once we know the limit orders and what prices they're at and things like that, we can do things like we can look at volume and we can sign that volume as whether it was market buy or market sell, right? There's that level. But then there's this next level, which is where is that order flow actually coming from? Is that order flow coming from a spread trade? Is it coming from a news event? Is it coming from changes in expectations based on economic data that was released? Or is it coming from dealers that have to replenish their inventory at the beginning of the month? Right. And so we can kind of use all of these little hints to figure out what certain flows were. And that's one of them is I see order flow over here and I see that this instrument moved way more than this instrument, then I know that flow was being driven by spread trades. And then that allows me to kind of separate those things out to make my own decisions. So I'm coming in here this morning and I'm looking, I see some buying. The robot took a long. I'm not seeing like a ton of change in spread. So, okay, this is probably okay to take a long there. Except for that it's likely to be a quiet day and I'm not expecting a huge imbalance in the flows. So like with this one right here, I don't know, there's an iceberg at 07 that's awfully big. So that's kind of curious. But, you know, the robot, it wants to get the full 10 ticks or whatever. But if I had taken a scalp on that, I might have already taken it off. Might have taken it off at 08 when I saw a lot of, 26,000 contracts at 08. That's a pretty good distribution, maybe a chance to get out, right? Because I'm anticipating the future orders. And I'm saying, well, I'm not anticipating a huge change in future orders. Ergo, I took a trade, I made a little bit. I should be happy with that. Versus if I'm expecting a huge imbalance, I'm gonna let it go longer until I've seen that whole flow come through. Yeah. Okay. Andre, account for volatility of entries. Look for spread action. Don't hesitate to trade ZN when ZB is too risky. And mostly when you see spreading action, people working both products. There you go. Yeah. So one thing that I will say is because a misinterpretation that you might get from everything that I just said there was like, if we're moving up and I'm seeing a big change in the spreads, that maybe I don't want to trade it or something. That's not true. But you have to have like both the outright direction and the change in the spread like squared away in your mind. Like, I know why we're buying, and I know why we're buying ZF more than ZB. Because when you're getting strong flows and spreads, you tend to get strong flows in the outrights and big moves in the outrights. So a big volume in spreads is indicative of higher volatility and better trading action. Okay. Let's see here. Gun Driver. Getting orders filled is always the biggest stumbling block for retail traders, in my opinion. Is there one platform or data source is better than another with respect to order filling? So this is a weird kind of a subject. So the thing is that if I come in and I use a market order, I'm always going to get filled, right? You always get filled if you use a market order, right? But you might have been able to get filled with a limit order. And that's one tick on each side of the trade that you're giving up if you're using market orders. So this is one of the things that is really interesting when you're doing backtesting, is if you do your backtesting and you tell it always to use a market order, well, your algo is always going to lose that one tick on each side. When you're doing the backtesting, since it doesn't actually know what the liquidity was like at that time and whether the opening price was, what the bid and offer actually was at that time, it doesn't know if that opening price was a bid or an offer. So sometimes it will give you the limit price despite you using a market order. So some backtesters, depending on how they handle this, can give you better results than the live will because of that. And 2 ticks on each side can be significant. That can be the difference between an algorithm that loses versus just kind of breaks even. Because if you're able to capture that spread on both sides, very, very good chance that you can break even. Okay. So this is one of the places where order flow is really, really valuable. So if I'm looking at ZN right now, let's recenter it because it seems like things have kind of evened off. If I'm going to buy it right now, it's 3,700 on the bid and 1,500 on the offer. So I could market order into it. Okay. Well, in this case, this heuristic would be wrong. But what are the chances that you're going to get filled with 3,700 in front of you? Not necessarily good. In this case, we're kind of moving down, so maybe it's better to say we're going to sell. Okay. Right now, it's the bid and the offer are even, so you probably have a fair chance at getting filled. But the less that there is on this offer, the better a chance you have of getting filled. So that's one thing that you can use to your advantage, is if you have the DOM and you can see the inside bid and ask, you have an easier time of getting that limit order fill. Of course, maybe you actually want to get filled at 06, and then who knows if it comes down for you. Right? But that's kind of the game. So, in terms of platforms, well, is there one platform where when you submit your order that you're substantially more likely to get filled from one platform to the other? It could be, but if you are playing that game as a discretionary manual trader, you're playing the wrong game, right? That stuff should only matter if you're an algorithm. Okay, and then the milliseconds between, if this one gets filled or not, and it's milliseconds, and then that can really, really help an algorithm, right? But if you're a human and you're trying to play those games, you're not going to win at that game. Okay. If we're just talking about the backtesting results, well, all platforms are going to have an issue with this to some extent because they are ultimately using price data. Now, NinjaTrader has historical bid ask. So it can see when we're at the open, what was the bid and the ask at the open, and it will tell me if that opening price was a bid or an ask, and so it can be more accurate because of that. So, but it's not perfect. So I would say that in NinjaTrader, I would still add 1 tick of slippage to account for the difference between, like, you're accounting for the difference between what it says is the historical bid ask and what actually ends up happening when you're live. There's still that difference, right? But if you're trading in TradingView, they don't have the historical bid ask. And so I would always assume 2 ticks of slippage if you're backtesting in TradingView, for instance. Fair enough. Backtesting isn't realistic in Thinkorswim. Yeah, I think that they kind of have the same problem. So if you go and you do Thinkorswim, and then again, assume 2 ticks of slippage. Or if you're doing stocks, assume the spread times 2 that you lose on every trade. Then you would get more accurate results. And especially if you're coming in and you're executing manually, or your robot accounts for the inside bid ask and the order flow and stuff, then you will actually perform better than your backtest because overall you're probably only going to get 1 tick of slippage executing manually. If not, get both sides something. So what about the data source? So it really, I think what it comes down to is the historical bid ask. I've never seen, I've never been able to look into different data feeds that support that feature to see if their bid asks, historical bid ask data is different. But I guess my point is that at that point you're kind of splitting hairs. There's still like this limitation in what you can simulate versus what is live. And so the solution is, when you're backtesting, just assume a certain amount of slippage. And then you know that you'll do better. Okay. Now, if we're just talking about how good does the data look when it's live, which matters, then there's a significant difference between the data feeds, right? CQG and Rhythmic, which are the most popular, are kind of like the bottom tier of data for futures. And then you get into some of these like, I can't even remember the names of them now. I have to go and pull up the control center. Configure. IQ feed is kind of a step above that. IQ feed and Kinetic, quite a bit more expensive. And then probably the best for futures is the Trading Technologies data. Thinkorswim uses DX. Oh, really? Well, they're not bad. They're not bad. At least like the live order flow data that you get from them is good. Yeah. But you see, in that case, the problem is the inherent limitations of backtesting and not necessarily your data source, right? So just factor in the spread. Like a good backtester should have an option to say, and this is one of the things that just kind of honestly makes me mad. Honestly, it makes me mad is some platforms. So if I come in here to NinjaTrader and I can come scroll down and where is it at? Instrument, price, type, value. They're going to be up here. Somewhere in here you can put in slippage. I don't for some reason I'm not seeing it. Slippage. There it is. Slippage. So on here, and when I'm doing a good back test in Ninja, I usually start with 0, just because whatever. But then when I get serious, 1 in Ninja Trader. Some backtesters don't include this feature, and it's like an absolutely essential feature to be able to do useful backtests. And if they don't have it, I guess you can kind of calculate it yourself, right? You can come in and you can say, what is the tick size of that instrument, or what is the average spread of that instrument if we're doing stocks, times the number of trades, and then times 1 or times 2. And then if you subtract that out from your profits and you're still profitable, then hey, maybe you can, it stands up over 5 years, and you know the metrics like your Sharpe ratio still look good, then you might have something. Now, there's another issue though, Gun Driver, if I'm honest with you. There is kind of a gulf of profitability. So if I'm looking at, this is your profit, and this is time frame, there are strategies, and this is like that we know of, at least, okay? There are strategies that make money on short time frames, and then there's this gulf where it's like intraday, it's really hard to predict what's going to happen in the next 30 minutes. And then it kind of goes like this, right? So there are a lot of strategies that we know that run on daily, weekly, monthly bars. And there are strategies that we know that works on sub-second time frames. But this period between like 5 seconds and 1 hour, we don't know. There's, you know, I'm not aware of any good trades in that area, right? Problem is, this is where we as retail traders want to play. The only strategy that I know of that really works in this place is what we do: informed trading supplemented with order flow. That's what we do. That's not really backtestable, is it? Because like, you're talking about news and you're making all of these interpretations and things like that. You could automate it. You could say, I'm going to use ChatGPT to interpret all of the news headlines that are coming through, and to go and read the Wall Street Journal and Zero Hedge and all of these analyst reports to make some calculation about what the order flows are going to be that day to give me a bias on the day. But you can't backtest that historically. I can automate it, but I can't historically backtest it, right? So you can't get into this spot. So the reality is that if you're backtesting and you want to backtest and make a profitable strategy, you probably are going to be making a strategy that's somewhere over here, right? That's somewhere on the right side of this, higher time frame strategies, meaning momentum portfolios, mean reversion sorts of things, maybe value plays, things like that, right? And the backtester that you get in these platforms is completely unsuitable for that. I can come in and I can tell it to backtest 5 years over this one instrument. I can tell it to backtest across multiple instruments, but it doesn't really show me if I'm trading all of those instruments at the same time and I'm limiting how much I get into here and this and that. I think I can kind of program something that does that, but like the backtester was not built for it. And when you get into that world, usually what you're actually doing is you're going to buy a different kind of data feed that is entirely for historical data. So like Norgate is probably the most common one that I would recommend. And then you're probably programming it in Python and doing all of the logic yourself. And then you can factor in these things like the spread and stuff like that. But for a position that you hold for multiple days, that's like trivial, right? if you want to do, but the bigger thing is, if you really want to do algorithmic trading, your time is probably better spent trying to develop a momentum portfolio or some sort of a portfolio strategy rather than scalping. Scalping is for those of us that think we're really smart and we want to be super involved in the markets and like on the edge of our seat, listening to what's going on and making our own decisions, right? And then you can be successful with it, but you probably lose money. You gain a lot of experience and knowledge. Is it worth it? Only if you really enjoy it, I guess. Let's see here. I'm trying to use the Nolan method of quick in and out order flow. Trading is why I'm asking these questions, because this method relies on executable order fills. Oh, okay, yes. You meant Norden, yes. So that's really more of a market making approach. And you're correct. It's not really very practical to backtest that. Now, in NinjaTrader, my tools allow me to backtest that kind of stuff. Because what my tools do, this stuff that you see up here in the upper right? What this is doing is it's reading what the current inside bid and ask is, and then it's saving it out to a file, which the platform doesn't do on its own. So I save that limit order information so that I can do historical backtests with them that will be accurate. And then you could try and do that sort of stuff. Although I haven't really found... I know. So like the thing with the Norden method is it is essentially market making arbitrage, which is like these two instruments should be highly correlated. This one ticked up, so I think that this one should tick up too. And then where being a human is useful is to be able to say, well, why did this one tick up? It was just random, so maybe actually I should sell this one because it's going to come back into line with it. Right? Funny that it just ticked down just as I said that, but right. And so you as a human understanding the news and the correlations between instruments and the reasons that different instruments are correlated can sort out better than the algorithms in some instances, why one should be moving up or not. And you can make that quick one tick arbitrage sort of a thing. And, if you were really to do it properly, you would buy in one and sell in the other. But we're humans and we're not that fast. And so maybe you just sell the one that you know is out of line. That's what you're really trying to do with the Norden method, right? And the issue with that is that if I come into like ZN, which is basically the most liquid and efficient instrument in the world, opportunities to do that are pretty limited. So you really need to have a situation where you have an instrument that for whatever reason isn't very efficient, and you have some sort of a special data advantage. Like for instance, you could do it in the micro treasuries. If you somehow were special and had free access to broker tech data. So broker tech is the actual cash treasury market that the CME runs or that the CME bought. And the micro treasury yield futures are based on the yields that are being traded in those cash treasuries. So when you come over here and you look at especially the 2-year and the 30-year, the spread is insane. See that? The spread is insane. And if you have the broker tech data to come in and see the last executed trade, what was the actual yield for that? And then I can use that to say, oh yeah, I can offer a bid that's closer than that. Then you could totally do that method because this is such an inefficient instrument because not very many people are trading it. But I've even been like, I'm willing to pay for it and everything, and I've had a hard time getting broker tech data. So, right, I haven't been able to find a place where I really felt confident that I could execute that. I can kind of maybe do it in ZN sometimes, but it's like, I don't know. It's a little bit of a wash. It's not that effective. And then the problem is sometimes you get stopped out and you lose 2 or 3 ticks, and it kind of screws the whole thing up. But now, going back to something else you said though, Thinkorswim uses DX feed for bookmap. It's useful, but ... So DX feed gives you NASDAQ total view order flow data for stocks. There's multiple ways to get it, but DX feed seems to be the most accessible. And my experience with that has been that the order flow inefficiencies are like huge and insane in stocks compared to futures. Futures are so efficient. And this brings me to a very important subject to talk about that I completely forgot about, but you reminded me, Gun Driver. Guys, pay attention. They're going to change the pattern day trader rule. Did you see this story yesterday? Wait, let me pull it up. Because maybe you won't believe me. Maybe you won't believe me. Where is it? Here we are. I'm not a robot. That's a motorcycle. Plus. Okay, Bloomberg. Day trading restraints to be loosened under proposed rule change. U.S. regulators are finalizing plans to replace a controversial rule that would dramatically lower a threshold for retail traders to trade equities and options more often. The Financial Industry Regulatory Authority, or FINRA, is looking to rework the pattern day trading rule that limits investors with less than $25,000 in their margin account. Oh, that's the open. That's what it was. Okay. That limits investors with less than $25,000 in their margin account from borrowing to trade 4 or more times in a 5-day period. In a proposal being prepared for FINRA's board to eventually vote on, retail investors would need to have only $2,000 in their accounts for such trades. So they're going to change the pattern day trader rule from $25,000 to $2,000. Guys, this is huge. This is huge. Woohoo, Americans can finally trade again. How long has the pattern day trader been in effect? I thought it was basically always been in effect. At least ever since electronic trading has been in. I thought this was like something they put in place in like the 70s. More people getting wrecked. I mean, like, here's the thing. A very large part of why retail traders trade futures, of the retail traders that are trading futures, very large portion of them are doing so because of the pattern day trader rule. So I think this is a massive change for us. Like, there's not going to be as many retail traders trading futures, is there? I think that there's still going to be some use for it, right? Like, here you get small instruments and you can get direct exposure to an equity index or the Treasuries, for instance, right? But guys, I've looked at the order flow on stocks, and there is crazy stuff that goes on in the order flow in stocks. I've seen many situations where you'd see a stock like going up, and they're selling it outright the whole way. Like, basically, there is massive selling in that instrument, and you don't notice because the equity index or whatever is kind of propping it up. And then sure enough, next day, that instrument just gets killed. And I've seen many cases, like one in particular with GameStop, where it was like I could see all the retail traders going in and buying it and marching to their doom. Knew exactly what was going to happen because you could see the order flow. So I think that there could be some really strong opportunities for us doing discretionary scalping with stocks if the pattern day trader rule was you only need 2,000 in your account. And with stocks, you can still, just do one share or whatever it is, right? Like, especially if on top of that, you're trading a broker that doesn't have commissions. Like, come on. So, my current thinking, I don't know, it's kind of funny. Some of you guys are kind of like, you were very dismissive of it. This is a game-changing change for retail traders. Retail traders are probably still going to lose money, but you're going to see a lot more people trading stocks. And I think that means that we're going to have to look at stocks more. I think so. Now, if I scroll down here, the existing rule was adopted in 2001. Oh, that's interesting. FINRA is expected to submit it to the SEC for final approval by the end of the year. More than 50 brokerages and clients have written to FINRA, which requested comments on a potential rule change in late October. If the current iteration of the proposal is sent to FINRA, it will then go through an additional comment period before progressing to the SEC. An actual rule change may take as long as a year to implement, according to people familiar with the matter. So we get a year to prepare for this. But I think that a big part of our strategy here is get the inventory cost basis on TradingView, get NASDAQ total view data. Maybe in October, November, or maybe beginning of next year, we start doing that. I don't know. We'll see. Kind of depends on if I'm able to trade. Like if, I end up unemployed again, maybe we buy this time around, we buy the NASDAQ total view data and we stick around until the close, which will be rough for me. Sitting here talking for like 6 hours is hard. We're gonna have to keep our eyes on Wall Street Bets. Once that hits, they'll go crazy. I don't think I saw that on Wall Street Bets, actually. Let's go look.
Order canceled.
Okay, so our algorithm did okay. It bought. We got the little move up. And, actually. No. Yeah, that's correct. Okay, it got out there. Yes. I thought that should still be a blue down arrow, but it's not. It's a sell. But it exited the position there. So it took profits on it because it had been an hour. But turned out it was okay. It got a good price for it. It's fine. If TradingView would manage to offer a DOM as nice as Jigsaw, it would be amazing. Yeah. I tell you what, TradingView is definitely the best charting platform, but it's not perfect. And even though I think that it is a better charting platform than NinjaTrader, I would rather use NinjaTrader. I'm tired of my job 20K into 0 day to expiration SPY calls at the open. Yeah, I'm a little bit concerned about that trade, especially since the open has been a sell. But what price did he put them in? I don't know. I didn't see anything about it on Wall Street Bets. I learned about it from the what is it? That Twitter account that basically hates that Congress can whale. It's like whale something, right? Frankincense Smith? No, it's unusual whales, I think. No, that's not it. Unusual underscore whales. Yeah, that's where I found it. That's where I learned about it. And I was like, oh wow, there's going to be so much. Pattern day trader. Past week. There's a thread on r/stock market with 38 comments. Oh, here's one from r/stocks. I didn't find that one yesterday. Here's the one that I learned it from. There's nothing in the r/day trading subreddit. Day trade rule changes. They want more people to donate to the market gods. Don't scare them off. That'll be our exit liquidity. It's really funny that all these guys from day trading are like, oh, this is a terrible idea. Listen, it'll increase market liquidity. It'll be an overall positive thing for the markets, I think. But people will probably lose money. I have to say, though, I think there are opportunities in stocks that there aren't in futures. Because in stocks, so the thing that the big change that we will have to make is we're going to have to start using scanners and all of these other kind of tools to figure out what are the best stocks to trade that day. Essentially. And then watch the order flow on those. Want the cash settlement time to be cut down for cash accounts? That's true. Much as I've hated the 25K rule, brokers are asking for trouble if they let amateurs borrow like that. Nah, because they'll only let them borrow if it's like, you know, they're not going to let you lose more than you have in the account. So I think fine. How much demand do you suppose there actually is? A ton. There was a lot of people basically trying to day trade stocks anyways. And if you look at all of the people that are basically trying to do prop firm evaluations, I bet you that like 70-80% of those would probably rather just day trade stocks. You think maybe you could get more prop firms that are in stocks? That might be interesting, but... Reddit is so freaking hilarious, man. Because I can't tell you how many times I've come into these subreddits and seen people complain about the pattern day trader rule. And now it's happening and they're all complaining about it, about how terrible of an idea it is. But that's because before it was the people that are actually like, you know, affected by the change and would actually day trading. And then now it's all of the people that are just typical Redditors commenting on it. that are kind of cynical and anti-markets and anti-ever take any risk ever. I wonder, one of the things that bothers me is that in our society, people are not willing to take risks as much. And that's been a big problem. And I wonder if part of it is just the internet, that the overwhelming and prevailing narrative that you see in online discussions is never take any risk. I agree, it's cynical. Wasn't easy for me. Don't want it to be easy for you kind of logic. Yeah. So something that I've noticed with Gen Z is that they are absolutely terrified to be thought of as different. Like when I was a kid, there was definitely, I mean, come on, there's always this thing in high school that's like, if you're too weird or whatever, people are going to talk about you and maybe it's not good for your social life. But the kids that were different, they didn't really know or care what other people were saying about them, and it didn't matter. And I, especially after school, I've kind of realized that, what? All of the conformity, it just hurts you. The conformity just hurts you. In this world, to really have success from your social standing, you have to stand out somehow. But Gen Z, they're worried that they're going to do something and it's going to be pasted on the internet and then their lives are going to be over. They're absolutely terrified about it. And you go on TikTok, it's like somebody wears the wrong thing and everybody gets uppity about it. It's like crazy. And so Gen Z has basically been conditioned to be super adverse to taking risks, especially to taking social risks. And I think society is paying for it. It's kind of part of why something I think about a lot is, man, if I had the opportunity to, I don't really feel like that I do right now, but if I had the opportunity to take risks and start businesses, that I should take it because nobody else is going to do it. It's just like the interest rates suck and they only want to fund AI ventures, so now is probably not the time. Maybe a year from now, it'll be a better place. Hey, can they bring down the interest rates? I don't, and then that's the other thing. Probably we should have spent more time talking about today, but the Federal Reserve is supposed to cut in September, but I think we're only looking at like a 70% chance. And with the way that things have been going, I'm kind of worried that they're going to say, nope, not in September either. Because we need to see how these effects go, and we're worried about inflation, yada, 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 yada. Meanwhile, the tech industry is bleeding. It's so bad right now. Listen, there's like 1 million people out there on long-term unemployment. I guarantee you it's more than that. Like the number of people that like they've been unemployed for 1 or 2 years is way higher than we realize. Some industries are getting absolutely savaged by the high interest rates. And we got to keep in mind that we have a high interest rate. Because we had inflation, we have a very, very tight financial conditions right now. Very tight financial conditions. Like the fact that we are like surviving through this and like kind of treading water is really quite amazing. And I'm very, very concerned that you keep the rates high for too long, you are going to create a death spiral. It won't seem like it right now because we are in like what is seasonally the best time of the year. But you extrapolate things out into October, which tends to be a weak time of the year, and we have a market rout in October, September, especially if some of these trade deals don't go very well. And then you're really going to need the economic support. And guess what? It'll be too late by that point. It'll be too late. David Levinson doesn't think rate cuts till 2026. Wait, please no. I need a rate cut now. I would like a rate cut now. Here's the thing. Like, let's think about this from a larger, much higher time frame strategic perspective. I think that it's all about artificial intelligence. The actual practical use of artificial intelligence right now is a little bit questionable. I think that companies are laying people off and shifting into AI to try and get ahead of it, even though it's not too practical right now. Agents don't work. They're not accurate enough. I think that AI probably is a help to, like an assistant. That might result in a world where you need more people. But in either case, it also results in deflation. Artificial intelligence is literally the largest deflationary force humanity will ever see. And we're sitting here with high interest rates at the beginning of it. Do you see the problem with that? And what happens here at the beginning and how competitive we are relative to other countries at the beginning of this age of AI matters big time. So basically, what you're doing is you're cutting America's feet off at the beginning of the race. Yeah, I get it. There's like some concerns about deglobalization and inflation coming from that. One, it hasn't happened already. Two, there's other factors in here. I am willing to accept slightly higher inflation, okay? Like having inflation numbers that are spot 3 instead of spot 2. If it means that we get a good place in the race for AI. Seriously. I think that, this Fed member who was saying that he's going to vote for a rate cut this month. If I was on the board, I would probably vote for a rate cut this month too. I don't know about what I would have done in past months. I've kind of been the like, well, let's just wait and see how it turns out. We got some time. I think that's past now. I think that they need to do something now, and if they don't do something soon, it's going to be trouble. The U.S. could go into a recession, and the U.S. could go into a recession at like exactly the wrong time. Some of the Genius Act stuff that's coming out will be a bit game changer. People are diving into the details, and one of the bigger nuggets is tying stablecoins to U.S. Treasuries. I think that that's a gross misrepresentation of what's going on in there, right? Basically, what's happening is they're saying, okay, if you're going to run a stable coin, then you have to invest the assets in certain things in order for it to be safe. Which essentially means treasuries. So the guys that are, the money that goes into stable coins will probably have to be used to buy treasuries. Now, if stable coins get more popular, that could be a big problem. Because that is a relatively major source of demand for treasuries. I don't know, man. You're going to have to issue a lot more treasuries to deal with that if they become popular. But this is also a big problem for the cryptocurrency world. It is. Tether does not have its assets invested appropriately. A lot of Tether is backed by Bitcoin and other cryptocurrencies. So they would not be in line with the regulation. So what's probably going to happen there's literally no. I think you misunderstand what they're saying. They're not saying that like the value of the stable coin is directly tied to the treasury or something like that. No, what they're saying is that if you are running a stable coin, there are strict regulations on what the money that you have taken from people can be invested in, how it can be held. I have read the bill, actually. Yes. I have read the bill, actually. I haven't read the latest version of the bill. They've been changing it. This was like a month ago. But yes, I absolutely read it. Because, I read it with the mind that it will tether be in compliance with these new rules. And my conclusion is almost categorically no, they will not. So what is likely to happen here, actually, interestingly enough, is Tether will split. This gets crazy, guys. This is where it gets crazy. Is they will have like the Tether that exists today, and then they will have a new Tether that is like US regulated, allowed Tether. How is that going to work? Well, hopefully the people don't try and take their money out of Tether, because if they try and take their money out of Tether, it's not all there. And the cryptocurrency world is just gonna be nasty. It's gonna be nasty, nasty, nasty. Well, there's a couple of companies that also own cryptocurrency, you know, like MicroStrategy, or it's just called Strategy now. Couple of other countries that own, or companies that own some now. Yeah, if something happened in the cryptocurrency space, especially if we had a recession, would be ugly for cryptocurrencies. And the whole stablecoin, this Genius Act is kind of trying to avoid that, but they actually may paradoxically, that's the thing that's funny, is the cryptocurrency guys are like all for it. They think this is the greatest thing because they view it as like government sanctioning of cryptocurrencies. Or like what your gun driver is saying, that like we're tying crypto to treasuries. That must make it safe now, or something like that. No, that's not what it means. That's not what it means. It means that the stable coins will have to buy treasuries. You give them $1 million, they're going to take that $1 million and buy treasuries with it. They can't go and buy stocks with it. That's too risky. And they risk the possible losses, and they wouldn't be able to pay people back when they ask for the money back. That's all that bill is about. It could paradoxically kill Bitcoin because the industry is not in compliance with those rules right now. To be understood as all-in short Bitcoin in October could be, Andre. I don't know, man. It could be. I think that there's a lot of things that are still kind of positive for Bitcoin, though, right? Like the administration is extremely friendly to it. We're kind of coming up on some supply constraints for Bitcoin. These companies are buying into it. I don't want anything to do with it, but I think that Bitcoin probably continues to move up. If there is a recession, though, if we start to get to the point where it's like we're sure that we're going to have a recession, I'm 100% going to go short Bitcoin. I don't know. I probably wouldn't have the capital to do it at that point, but that would be the play, I think. Would be short Bitcoin if we go into a recession. Generate increased demand for U.S. debt and current cement the dollar status as the global reserve currency by requiring stablecoin issues to back their assets with treasuries. Yes. So, I mean, it doesn't necessarily have to all be treasuries, but the way that it's written is basically like they're going to have to buy treasuries. And you know what? That's the way that most banks do it, right? Banks own a lot of treasuries. Okay. How much increased demand for treasuries will this actually generate? I'm not entirely sure. But there's kind of potentially this problem where it's like the Federal Reserve goes and prints money, and then that money is supposed to go and get invested into assets like stocks to generate growth. And if instead it turns around, it goes into stable coins so that they can buy Bitcoin, and then the stable coins go and buy treasuries, that's That's not a good feedback loop. So don't think of it as like, well, this is good for Bitcoin because it ties stable coins to the US Treasuries. I think that's what people think when they hear you say that. But what it does do is it's a pretty big change to the Bitcoin ecosystem and maybe the financial ecosystem as a whole that could have very unanticipated consequences. It's a complex system, so I can't say for sure what will happen, but I'm a little bit concerned about it. I don't think that the Genius Act is outright just a buy Bitcoin like the crypto bros think, right? But yes, it requires them to hold their assets with treasuries so that the stable coins, so that they don't have a risk of collapse. Because right now, Tether it's not backed. It's kind of scary. It's kind of crazy. Okay, well, the Treasuries made another really strong move up. My algorithm, it looks like it took another trade just before it happened too. Wow. Hey, that worked so well. I can't believe it. Well, I would like to sit and gawk at it, but it is time for me to go. So I will see you guys tomorrow. Stay